Today on Stock Talk, I'm speaking with Rick Rule, who's President and CEO of global asset manager Sprott. Now, Sprott is based in Canada and is a precious metals investor with more than 17 billion in assets under management. And Rick has been active in investment markets for almost 50 years now. Rick Rule, welcome to the program.
Nigel, thanks. It's a pleasure to be with you.
Yeah, thanks for making the time to join us from Washington State today. The year-to-date return on gold is up maybe 30%, including that history-making spike beyond $2,000 in early August. Gold's performed exceptionally well in 2020. This must be a pretty exciting time at Sprott. Has there been much interest in new investment inflows?
There has been. We joke, we worked hard in the resource space, including the gold space, all through the bear market. So the internal joke is that we worked 8 years to be overnight successes. Certainly, our assets under management in the last 12 months have almost doubled, both because of organic growth, which is to say the increase in share prices and the increase in metals price, but also in terms of the influx of assets. So it's been obviously a very pleasant circumstance, particularly pleasant given the circumstance that it followed.
Well, let's talk about some of the long run history here. So for more than 30 years, the gold price has stayed in a band of maybe between 200 and 400 US dollars. Obviously, that range still creates significant volatility and ample room for trading and trading profits. In the last 2 decades, it seems the gold price has been really running north. Can you tell us a little about the history of the gold price and what some of the factors have been that have triggered the spike? You can see in the chart really coming around 2005.
Gold is interesting in that it triggers the two most important human investment emotions, which is to say fear and greed. Most investments are motivated by either fear or greed. And the fact that gold motivates both fear and greed makes gold bull markets, when they occur, dramatic, both in terms of duration, they're long lasting, and in terms of dimension. Gold's traditional primary mover has been fear. It's the only medium of exchange, well, the range of precious metals, gold, silver, platinum, and palladium, are the only mediums of exchange that are simultaneously stores of value. Most other forms of payment are promises to pay, be they an Australian dollar, the US dollar, the euro. But gold represents payment, not a promise to pay. Aristotle pointed that out a long time ago. If you really want to do history, we'll go way, way, way back to Aristotle. It's important to note, too, that gold has fulfilled this role as a store of value and a medium of exchange for thousands of years and different cultures. It simultaneously was useful in South Asia, East Asia, Eurasia, Africa, and the Western Hemisphere. So there is obviously a long time perception of the utility of gold. Gold traditionally has moved on concerns about maintaining purchasing power relative to other asset classes, particularly conventional savings assets, and more particularly in the last 200 years about the ability of savers to maintain purchasing power in government-denominated savings products, which is to say bonds. We have been, since 1981, in a bond bull market. Of course, bond prices rise and fall inversely to interest rates. And if you merely look at the US 10-year Treasury interest rate, at the end of 1981, it was about 15.5%. Now it's about 0.6%. So the bond has enjoyed, if you will, a 95% escalation in price relative to yield. I would suggest, in my experience, that a 38-year-old bull market is, if not over, certainly long of tooth, closer to the end than to the beginning. And if you believe, as history has demonstrated, that the gold market operates contra to the bond market, the fact that the bond market is at or close to the end of a bull market suggests that gold is at the beginning of its own bull market. Now, if you look back at the last 50 years, The most important demonstration of this was probably the decade of the 1970s, when the gold price ran from its admittedly price controlled 35 US dollars an ounce to $850 an ounce. That coincided with things like then President Nixon closing the gold window, which is to say, he took the US dollar from literally a gold standard, where foreign creditors had the ability to exchange their treasury certificates, their dollars for gold, to a floating abstraction, to a promise to pay. He didn't do that for any reason other than the fact that the United States was living beyond its means. And foreign creditors and later domestic creditors came to understand that to be true. And the consequence of that is that gold did very well relative to the US dollar and, frankly, anything else. So I think it's important to note that gold's real strength, well, other things can move gold because other things cause people to be concerned. The most important thing that moves gold is concern about the purchasing power of savings denominated in other asset classes.
Well, Rick, I want to get your view on some of these economic factors that may drive gold, in particular, interest rates and inflation. So, firstly, if we can talk about inflation in isolation, gold is widely considered an inflationary hedge, and what we're witnessing at the moment is persistently low inflation in many countries and in some cases intermittent deflation. Now, during the 1970s, we witnessed one of the worst periods of inflation and we saw gold spike. To what degree should investors still consider gold and other precious metals an inflation hedge?
I think gold has proven itself to be an inflation hedge for a millennia, and it continues to enjoy that role today. Understanding the nature of inflation, the pernicious nature of inflation, becomes more difficult as the economy becomes more difficult. In the United States, we use something called consumer price inflation, but we adjust consumer price inflation arbitrarily for what are called utilitarian reasons. So I would argue that the inflation statistics that you currently see aren't accurate. They don't, as an example, account for the buildup of debt, which is to say they don't account for future inflation, only current inflation. Interestingly, in the United States, the consumer price index doesn't include the increase in taxation, which is, I would suggest, a cost of living. Now, in truth, I wouldn't complain so much about the index, I guess, if I didn't have to pay the tax, but that's not on offer. And I would also say that it's arguable that we have seen inflation in other investment asset classes. It's arguable in the United States that we have seen inflation in technology stocks, in the broad stock market, and perhaps in residential and commercial real estate. The level of yield that people are willing to accept now, which is to say the capitalized value of income streams, is at all-time highs, partially a function, of course, of the low interest rate. But I would also argue that inflation in other asset classes and the burgeoning cost of government needs to be taken into account when people measure the future purchasing power of their savings, because it all gets called into question.
Turning now to interest rates, for the first time, we have 60% of the global economy, including 97% of the advanced OECD economies, having interest rates below 1%. Now, further, 1/5 of the world's interest rates are negative. We've seen central banks deploying very unconventional methods, and the world is now in a liquidity trap, according to the IMF, where it seems that monetary policy has very limited effect. Rick, can you share your views on this so-called liquidity trap and what the world will look like if interest rates, real or nominal, remain zero or negative?
That's an enormous question, but let's try to unpack it. What the IMF is saying is that when you stimulate an economy in the near term by lowering interest rates, What you really do is you steal consumption from future periods and you front load it in this period. The problem is that when you get to those periods, the demand in the economy that would have sustained you has already been used up. And so it takes larger and larger amounts of stimulus to generate the same level of economic growth. The trap that they're referring to is simply the fact that they have used fiscal tools to deal with policy circumstances for 20 or 25 years. And they are, to be inelegant, I think, beginning to run out of rope. Talking about interest rates, though, I think you need to begin by saying that we don't experience a free market in interest rates. That's not what we have. What we're doing really is we're engaging in a very, very popular fraud. Was there no government participation in the interest rate? In other words, if the free market, the interplay between savers and borrowers were at play, my suspicion is that the interest rate would be 400 or 500 basis points higher, much to the chagrin of many. It's important to note that this fraud is extremely popular with most of society. One of the things that you come to understand about a functioning democracy, and by the way, I'm not against functioning democracies, but one of the downsides is that a war plays out in a democracy between savers and spenders. The savers are not numerous. The spenders are very numerous. The spenders vote their interest. The savers vote their interest. In Australian parlance, I've been quoted on this before in Australia, an election about interest rates is like a discussion between four dingoes and a lamb as to what the lunch menu is. It's interesting that if you yourself sought to manipulate interest rates down, it would be a criminal offense and you would become a guest of the Australian state. But when Parliament does it, it's policy and it's extremely popular. So it's interesting to understand the interest rate in all of its manifestations. I should say, too, many people, perhaps because most people are spenders rather than savers, many people today don't understand what interest is. It's the compensation which savers receive for foregoing consumption in favor of the borrower. But it's more than that. It's a premium, a risk premium that savers receive to provide some compensation for any credit risk that they might feel about the credit status of the borrower, including the U.S. government. And it's compensation for the deterioration of the time value of money. I think it's very clear in this circumstance that were interest rates not manipulated, that the free market interest rate that we would experience would be much higher than it is today. And I think that the negative real and negative nominal interest rates that we face worldwide are the single most important determinant of the direction of the gold price.
Well, speaking about that fraud, on a Tuesday a few weeks ago here in Australia, the central bank cut the cash rate from 0.25% to 0.1%, which is the lowest rate in our history. At the same time, the bank also launched a $100 billion quantitative easing program to really drive down interest rates across the whole structure of the Australian economy, but also to depress the value of the Aussie dollar. Now, this tactic seems to be employed by many central banks at the moment. And in my view, Australia had to really follow this race to the bottom for interest rates. Otherwise, there would have been the strengthening in the Australian dollar. How do you see the gold price really decoupling and moving independently from, let's call them fiat currencies?
Well, that's a great question. You should begin, I think, by saying that gold is the only medium of exchange that doesn't have a built-in constituency to make it less valuable. To the extent that the Australian dollar got too strong in an export economy, you begin to reduce your exports, unless your producers can become much more efficient, which reduces many aspects of the Australian dollar. But Australia doesn't exist in an echo chamber. It's not alone. So to the extent that Australia does that to become more competitive in, say, coal or iron, the Brazilians and the South Africans are incented to do the same. So sovereign governments around the world, with very few exceptions, are incented to debase the value of their currencies. There is no gold parliament. There is no gold prime minister or gold president. There are no elections around gold except for that 24/7 election called a market. The consequence of that is that there is no constituency whose well being depends on the deterioration of the purchasing value of gold. Well, there may be. It may be that central bankers see gold as a vote of no confidence, and so they may see it in their interest. But the truth is that almost every fiat currency in the world comes from a political constituency, is supported by a political constituency that has a personal interest in devaluation. Again, a war by spenders on savers.
From an international trade perspective, weakening currency, as we're talking about, provides advantages to the domestic producers. What will happen to gold if a currency war, let's say, starts? And how likely is it that major economies will find ways to work together and use their spending power to really re-energize demand on a global scale?
I would argue with you that a currency war has been in place for a very long time, since the collapse, at least, of the Bretton Woods Agreement. The United States has enjoyed the world's reserve currency for a very long time and has used that so-called extraordinary advantage to extraordinary advantage. And many other societies have commented on the privilege that the United States enjoys and has used. And so I would argue, even as an American, that that war has been waged for at least 50 years, and that the principal protagonist has been us. Now, the truth is that although the US dollar is, in fact, a floating abstraction, it's the deepest and most liquid abstraction on the planet. And although many countries, for good reason, don't trust us, they seem to trust us more than they trust each other. Which means that they aid us being Americans, in winning this war. There have also been that separate type of currency conflict that you describe, which is competitive devaluation. Various nations, including the Chinese and the Japanese, have deliberately kept their currencies weak as part of a political strategy to strengthen their domestic economy and impoverish their workers to some degree. Relative to their closest competitors. And I guess I suspect that that will continue too. As to the ability of global governments to collude and manage this war, my belief is that all politics is local. Even in totalitarian circumstances, in the case of, say, Iran or China or someplace like that, domestic political considerations, even when you deal with dissent with bullets, is a very high concern. So the idea, if you ever believed it, that an American president or a Russian president or an Australian prime minister would be more concerned about some sort of esoteric sense of the well-being of mankind rather than its impact on people who might vote for him or her, I think is naive.
Well, maybe then the question is really orientated around gold. So let me throw something else at you. I think the core macroeconomic problems seem profoundly different from the problems that any policymaker has seen before. And while governments are wrestling with this enormous problem and the standard of living seems to be slipping for so many people around the globe, what will be the implications for gold?
I need to use the word afraid. I am afraid that the outlook for gold is very good. And when I say afraid, speaking as somebody who owns a lot of gold and is active in a gold company, for me, arguably, this will be a good thing. But the truth is, Nigel, my life is already good. The set of circumstances that takes gold higher is inconvenient for most of the rest of your life. A circumstance that debases savings, private savings, is not a good thing. Let's look at these factors, and that'll really show why I'm bullish about gold in a global context. Quantitative easing, which you referred to in the Australian context, if you did it, would be called counterfeiting. You're creating specious currency units, and you're not doing it for the traditional reasons, which is to say that an economy is growing so fast that there isn't sufficient monetary base to cover it. Issuing currency in the past has often been used not to stimulate inflation, but rather to limit the increased demand for insufficient amounts of currency in circulation. That's not what quantitative easing is about now. It's counterfeiting, clearly. The second thing is debt and deficits. There doesn't seem to be a political constituency anywhere in the world that's concerned about debt that isn't directly recourse to themselves. The idea that you borrow from somebody else, in particular somebody else who isn't yet born, by increasing the stock of debt and consuming the benefit of that at the present, is hugely destructive and amazingly popular. There is no political constituency in the world that votes in favor of living within their means, which is good for gold. The third, of course, is, as we discussed, the most important, the compensation that savers might receive for facing down the first two difficulties. My friend Jim Grant refers to the yield available in sovereign instruments like government-issued Australian dollar bonds as return-free risk. Think about the concept of return-free risk. Your government is making you one of the first promises it's ever made, which it will be able to keep. If you invest in a 10-year Australian bond, they absolutely, positively guarantee to give you back less money than you gave them. This is a promise that they will keep. It needs to be a promise that you consider whether or not is in your interest. My suspicion is it's not. And if you come to that circumstance, you begin then to look for substitutes for other savings products. The fourth thing that I think people need to note that many people forget about is that because we've been through a 30 or 40-year period of relatively benign economic times, people are very confident, and gold is under-owned. There is a study that I read, and admittedly this is US-centric, but I suspect it applies to some degree to Australia too, that precious metals and precious metals-related assets in the US market comprise less than 0.5% of the savings and investment products owned in the United States. And the 3-decade mean was between 1.5% and 2%. So if gold only reverted to mean for the reasons that we talked about, demand for precious metals and precious metals related assets in the United States market would go up from less than 0.5% to 1.5% or 2%.
We've spoken at length about gold, but your investment experience spans a broader spectrum of resources and commodities. Outside of gold, what other commodities should investors be watching right now?
That's a fantastic question. My own suspicion, first of all, is that the global economy will be weaker than other people perceive for the next 2 or 3 years, which suggests that in the very near term, demand for and prices of other commodities will be weak. Mercifully, I've been wrong for the last 7 months. So iron ore, copper, coal, all of the things that Australia does well have been quite strong, and I've been quite surprised, and frankly, of course, pleasantly surprised. My experience has been that bear markets are the authors of bull markets, and bull markets are the authors of bear markets. And in a bear market, what you find is that the selling price of a commodity is less than the cost of producing that commodity, which is to say that major industries, even iron ore in Australia, goes into liquidation from time to time. And although those times are terrifying, they're absolutely lucrative. Because if a commodity that's necessary for the continued existence of man, given the lifestyle that we enjoy, is priced for too long below the cost of production, that commodity becomes unavailable. Imagine, Greta Thunberg notwithstanding, a world without electricity 5 or 6 years from now. What you're saying is a world without oil, a world without coal, and a world without uranium. Inconceivable, despite the best wishes of the chattering classes. Similarly, it's said that the incentive price to put a new copper mine in production worldwide is US $3.50 a pound. If the copper price falls too low for too long, no sustaining capital investments get made, and we don't have any copper. Even if we can generate power, we can't distribute it. So my broad thesis is that low-cost producers, and mercifully for Australia, you are a low-cost, efficient producer. These commodities over the 5 or 6 year time frame, I think will do better than people believe. I'm pessimistic in the nearer term, but very, very optimistic in the longer term. It bears remembering, too, from an Australian point of view, that if the selling price of your product is in a relatively strong currency, which is to say the US dollar, but your operating costs are denominated in a weaker currency, which is to say the Australian dollar, the subsidy to Australian producers from that circumstance is very high. The virtuous circle associated with having your input costs moderated at the same time that your selling price runs is a lovely set of circumstances. And further, the very low energy costs that we're enjoying right now in a capital-intensive business like mining inure to the benefit of all miners, not merely gold miners.
Well, that bodes well for many Australian miners then. Rick, thank you so much for joining us on the program today and sharing with us your valuable insights.
Always a pleasure. I look forward to a return.
Absolutely. Thanks a lot, Rick.